The stock market has had its worst start to a year in recent history, and things could get worse as recession fears loom. Since World War II, there have been 13 recessions, defined as 2 consecutive quarters of GDP decline, and there have been 3 in the 21st century, 2001, 2008, and 2020, according to the National Bureau of Economic Research, and some experts say another one could be on the way. It's no wonder then that investors are worried about the Federal Reserve's ability to achieve a soft landing, bringing down inflation without hurting economic growth as it tightens monetary policy. The S&P 500 briefly plunged into a bear market last month as investors were whipsawed between inflation concerns and rising rates. Where exactly should you invest your money in the midst of a recession? In this episode, we'll take a look at how recessions affected the stock market in the past, stocks to avoid during a recession, and what you should do during a recession. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos on the best recession-proof stocks to include in your portfolio. How much do stocks drop in a recession? The S&P 500 surprisingly rose an average of 1% during all recession periods since 1945. That's because markets usually top out before the start of recessions and bottom out before their conclusion. In other words, the worst is over for stocks before it's over for the rest of the economy. In almost every case, the S&P 500 has bottomed out roughly 4 months before the end of a recession. The index typically hits a high 7 months before the start of a recession. During the last 4 recessions since 1990, the S&P 500 declined an average of 8.8%. In over half of the 13 years with recessions since World War II, however, the S&P 500 has actually posted positive returns. Prices lead fundamentals, therefore the stock market falling into a decline is traditionally an indication that most investors believe we're headed for a recession. When we do finally fall into a recession, that's usually a good time to get back into the market. Right now, it looks like 2022 is shaping up for a recession. In December 2021, the S&P 500 was at 4,942.53. By late May 2022, the index had fallen to around 3,900, giving up about 20% of its value. Stocks to avoid during a recession. Many S&P 500 investors are convinced a recession is on the way, and if it is, you'll want to know which stocks to avoid. Now, some of the biggest sectors to avoid during an economic recession are retail. The retail industry is one of the largest sectors for employment, with an estimated 15.6 million employees in the US alone. With that kind of employment, retail workers make up over 11% of the US workforce. In many recessions, retail trade is usually affected as individual shoppers relocate their budgets. When these issues arise, it makes sense for most people to cut out frivolous spending such as expensive clothes and beauty supplies. Restaurants and bars. The food service industry quite often takes a hit during economic downturns. In the aftermath of the 2008 recession, numerous restaurant chains simply went out of business. Others were forced to cut their labor costs by laying off workers. Thousands of restaurant employees lost their jobs, although many did regain employment within the industry as the economy began to recover a few years later. Leisure and hospitality. Unfortunately, quarantine and travel restrictions during the COVID-19 pandemic significantly impacted the leisure and hospitality industry. Hotels and rental car companies suffered massive declines in revenue. The 2008 recession also negatively impacted spending on leisure and hospitality. Even major players like Disney were forced to lay off workers or significantly reduce hours. This sector shed around 450,000 jobs between February 2020 and March 2020. The unemployment rate among these businesses jumped from 5.7% in February to 8.1% in March, revealing just how fragile the industry is to major changes in broader economic situations. Technology. Things are clearly very different in the technology sector. The 2008 recession and the COVID-19 downturn have shown that technology sector jobs tend to offer strong employment barriers against job loss. With more people working fully remote, the internet and almost every device, app and platform made surrounding it has seen growth. This growth leads to more money towards research and development, more money towards advertising, and of course, more money towards talent that can get the job done. Now, is the tech industry completely immune to economic hardships? Certainly not. The 2008 recession saw a decrease in the hiring rate in the industry. Recession-proof stocks. The best 3 categories of recession-proof industry stocks include pharmaceutical stocks. Pharmaceutical stocks, a subset of the healthcare industry, are traditionally considered defensive along with other industries like utilities. This is because even in the midst of an economic crisis, people need medication to be treated for illnesses. As an example, if you're on a blood pressure medication, you're not likely to stop taking that when a recession comes. More likely, you're going to stay on your medication even if it means that you have to find a new way to pay for it. This and countless other examples demonstrate why healthcare stocks can still be a good play even in an economic downdraft. Example fund. The Fidelity MSCI Healthcare Index ETF, FHLC, offers broad exposure to pharmaceutical stocks. Grocery stores. Grocery stores run on thin margins, which can make them tricky investments. During recessions, however, grocery stores often have an uptick in sales and profitability. As consumers trim their spending on eating out at restaurants, they tend to buy more groceries and eat at home. Even during the bleakest of recessions, people still need to eat, and grocery stores provide this necessary service in a more affordable package than restaurants. Utility stocks. Utility stocks fall into the same defensive, necessary category as grocery stores. Even when consumers trim back their spending, they still need water coming in through their pipes and power coming in through their lines. There will always be a demand for the product utilities provide, even during a recession. Utility stocks also tend to pay high and consistent dividends, which makes them more appealing to investors looking to get defensive. Example fund. The Vanguard Utilities Index Fund ETF, VPU, is a cheap and broad way to buy utility stocks. What should investors do in a recession? When there's a recession, here's what you should do. 1. Don't panic. Avoid knee-jerk reactions such as selling investments when markets are falling. You should crystallize some hefty losses by selling out of your investments depending on when you bought them and potentially miss out on any recovery. The ongoing uncertainty over COVID-19 is likely to amplify market volatility in the near future, so the key is to focus on longer-term goals and wait to ride out the inevitable bumps in markets. 2. Diversify and spread risk. Diversification is key for any investment strategy. Hold a mix of cash, fixed interest and shares, spread across global markets too so you're not overexposed to downturns in any one area. Make sure you're comfortable with your risk profile. This is the extent to which, in the pursuit of higher returns, you can stomach seeing some investments fall in value. 3. Keep costs low. All investment platforms charge for running your money, and there are typically fees for holding funds as well as trading costs for funds and shares. Make sure you're not paying over the odds for your investment. Platform costs vary, so you might save money by switching to one offering better value, boosting the value of your fund. 4. Drip feed money into investments. It's very difficult to time the market, which is where you try to buy or sell investments at just the right moment in anticipation of prices going up or down. It's even harder in a market characterized by investor fear with increased volatility. Instead, establish a regular savings habit and drip feed your money in. This will ensure you'll benefit from pound cost averaging, where you buy more units in your investments when prices are low. 5. Choose investments wisely. If you're investing directly in shares, look for firms that have strong balance sheets and business models. You want to find companies where demand for the product or service is relatively insensitive to the economic cycle, such as companies that provide consumer staples like supermarkets. You might also want to invest in sectors that will prosper whatever the investment climate. 6. Take advantage of cheap stocks. Amid a gloomy economic outlook, the stock price of investments may remain depressed. This means there could be a good opportunity to buy stocks at a bargain price. Some fund managers specialize in looking for undervalued companies that will prosper in the future. These include quality companies in sectors that have been hit by lockdown but can weather the storm. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.